This week on Wealth Track, why has great value investor Joel Greenblatt created a mutual fund combining a passive index with his actively managed long-short strategies? Gotham Asset Management's Joel Greenblatt explains next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management, Flexible Perspective, Rosalind P. Walter, and the Fairholme Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Ever since we launched Wealth Track in 2005, we have covered the agonizing question of why investors underperform the very funds they invest in. We call it the underperformance trap. One of the most dramatic examples involves a study Morningstar did of the top performing mutual fund of the decade from 2000 to 2009. The fund delivered impressive 18% plus annualized returns in an essentially flat market. But the distressing reality was that the average investor in the fund during the same decade experienced negative annualized returns of 11%. Why the huge discrepancy? The investors chased the fund when it was outperforming the market, buying high, and bailed out of the fund when it underperformed, selling low, thus missing out on the decade's gains. The reality is that even the best active managers have years of underperformance, which is a major reason so many investors are flocking to index funds instead. According to another study of the same decade, 97% of the top 25% of funds spend at least 3 of the 10 years in the bottom half of performance. 79% of them spend at least 3 years in the bottom quartile, and 47% of the decade's top 25% spend at least 3 years in the bottom decile. You can understand why so many investors bail. No matter how much we say we are long-term investors, most of us lack patience. By the second or third year of trailing the market, we are ready to switch to the funds that have been beating the market, and so it goes. This week's guest has decided that rather than fight human nature, he will work with it. He is both a great value investor and a financial innovator. Joel Greenblatt is managing principal and co-chief investment officer of Gotham Asset Management, a firm he founded in 2009 with his longtime business partner and fellow investor Rob Goldstein. He co-manages the Gotham Funds, long-short mutual funds run like hedge funds, but with much lower fees that go long several hundred stocks the firm deems to be extremely undervalued and shorts hundreds of stocks it determines are very expensive. His predecessor firm, Gotham Capital, ran a very concentrated hedge fund with only 6 to 8 holdings. After a 10-year run delivering 34% annualized returns, he and Goldstein decided to close it to outside investors. Greenblatt realized early on that most investors cannot emotionally tolerate years of market underperformance. In early 2015, his firm launched a new fund, the Gotham Index Plus Fund, combining index investing with their actively managed long-short strategies. I asked him why.
Well, there's a lot of ways to make money, but for people who are interested in active investors who are trying to beat the market, one of the truisms is that to beat the market, you have to do something different than the market. And that means your fund will zig and zag differently than the market. Often that comes with periods of outperformance and periods of underperformance. One of the problems for people who allocate to active investors is they don't like the periods of underperformance. Most investors aren't very patient. They often don't understand the reasons for that underperformance, and therefore they're not very sticky. They're not very patient to collect the periods of outperformance. So it's very tough. It's a challenge for both retail investors. It's a challenge for active investors. It's also a challenge for institutional investors because they have agency problems and behavioral problems, and they're judged as well over shorter time periods. So we were trying to come up with a solution that would take advantage of the ability that we believe we have to actively choose stocks that will do well on the long side and stocks that will do less well than the market on the short side. But we also need patience. So the question is, how do you bridge that gap? How do you bridge the gap between the fact that you need patience and there are often times when you're active by necessity that you're going to have periods of underperformance. So how can you minimize that problem? And I started a fund and I wrote an essay about it, and I said that I started it this way. I said, the strategy that's best for you is not only one that makes sense, but one you can stick with. And if there's too long periods of underperformance, which is a necessity usually for value investors, which we are, I'm not really helping the people I'm trying to help. So how could we bridge that gap? So we took it upon ourselves to look at the problem and try to figure out a solution, and we came up with Gotham Index Plus.
So how does Gotham Index Plus work? How does it fix the problem? Number one, that you've got to understand the strategy and you've got to have the patience to stick with it.
Right. So there's a few things we did to create it. Number one, we said that most people use the S&P 500 as a benchmark. For performance. So they're really comparing how they did. It doesn't matter if they're doing small cap stocks or all cap stocks or S&P 500 stocks. They use the S&P 500 as a benchmark. So when they're measuring underperformance, that's generally what we're using. So we started there. And what we do with our fund is you give us $1. We actually go out and recreate the stocks in the S&P 500 and the weights in the S&P 500. So we take your $1 and we buy $1 of the S&P 500 effectively. We don't charge for this portion. It's not so hard to go do that. But then we have an active overlay on top of just that investment in the S&P 500, in which we buy 90 cents more of our favorite S&P stocks and we short 90 cents of our least favorite. So we have a 90 by 90 long-short overlay on top of the index, where we're hoping that our long picks beat our short picks, and that's additive over time to the performance of the S&P 500. But because the base is the S&P 500, you minimize tracking error. So that's good. And the 90-90 portion, hopefully in most periods, will be additive. And when we've looked at testing this going backwards, it was very encouraging.
Right. So what's interesting is that in the past, when you and I have talked, you basically said that you thought it was not a smart idea to invest in a market cap weighted index fund, for instance, because you were constantly paying up. It actually, I think you figured out it cost you 2% a year in performance because you're constantly paying up for the most expensive stocks. But it's kind of, did you kind of throw in the towel and say, look, if everybody's going to use the S&P 500 as the benchmark, then we've kind of got to have that as a core to the Gotham Index Plus. The index has got to be the S&P 500. So, we'll take the cap-weighted market with all of its flaws.
Right. Well, so there was an article written in the Wall Street Journal. Jonathan Clements wrote it.
Yes, who's been a guest on Wealth Track many times.
Right. So he really hit it on the head. He said, index investors end up doing better than active investors, not because they're smarter. It's basically because they make less mistakes. When you have an index fund, people make mistakes. When the market goes up, they pile into it. When the market goes down, they pile out. Those are mistakes. But for an active fund, they pile in when the fund does well. They pile in when it outperforms. When the market goes down, they pile out. When the fund underperforms, they pile out. So they make twice as many mistakes. They have twice as many mistakes to make because of the under and outperformance. So an index fund, investors make half as many mistakes. So obviously, if you're trying to beat the market, you have to have some tracking error. We're trying to make that mostly positive tracking error, which no one minds, meaning you make more money. They only mind when you underperform. So our long-short strategies tend to do well in poor markets. Not always a guarantee, but certainly that's our goal.
And explain your long-short approach for people who are not familiar with Gotham and your work. And I know we interviewed you a couple of years ago. And that interview is available on wealthtrack.com. But for those people who haven't seen it, just explain that overlay, how that overlay works, so that we can understand that.
Sure, absolutely. So we take a look at the 500 stocks for this particular strategy in the S&P 500, and we rank them from 1 to 500 based on their discount to our assessment of value.
Right.
We value them with metrics that we've always used to value business. How much cash flow am I getting from that business? How cheap is it relative to all the other businesses that I could buy and other similar businesses? How cheap is it historically? It's the only way we really know how to value things. We rank them from 1 to 500. Value investing to us is not low price to book, low price sales investing. It's actually valuing a business and buying it at a discount, trying to leave a large margin of safety between those two. Here's fair value, here's price. Ben Graham said leave a large distance between those two.
And so you're still doing the traditional value analysis that you've always done, and in this case, you're doing it for the S&P 500 companies.
Correct.
So that's fundamental value analysis. You're still doing your homework with these 500 companies.
Exactly.
Right.
So we're buying a few hundred in the 90-90 overlay portion. The few hundred we think are cheapest. We rank them according to their cheapest and buy more of the cheapest than the second cheapest and more than the third. But there are a couple hundred companies, so a lot of diversity. We want to be right on average. And we short close to 200 of the most expensive. And so we're trying to take advantage of that disparity, but because these are all large cap companies, most of them are in pretty good businesses generally, we're trying to stick to shorting the ones that are trading at 50 and 100 times free cash flow, which are priced really for perfection, in our opinion. And so on average, that's not a good strategy, and usually those companies, we are hoping and believe, will not perform as well as the average.
So right now, Joel, if you're looking at the S&P 500, so which are give me a couple of companies that are the most undervalued, according to your analysis, and a couple of companies that are the most overvalued that you'd be shorting at this point?
For well-valued, in other words, cheap companies.
Cheap companies.
Yeah, I can give you a couple right now.
Mm-hmm.
Apple is one of our biggest holdings still. Some people think Apple is just another hardware company and it's going to crash and burn like all of them do. All of us had BlackBerries a number of years ago. And other people think, no, it's a network and it's an ecosystem of products that play off one another, and that it's really not just a typical hardware company.
And you're in that camp?
Well, the answer is probably gray.
Right.
Meaning somewhere in between is probably the right. But the stock is priced with double-digit free cash flow yields, meaning, in a 1 or 2% interest rate environment, and as a company like Apple, it earns huge returns on capital, has a great niche. Mm-hmm. The answer is probably gray, but the key is that I always say we don't own just Apple, we own a bucket of apples. We own a bunch of companies with similar characteristics. Gushing cash flow, huge returns on capital, nice market niche, and we don't know if Apple specifically is going to work out, but we do know and believe that our bucket of apples is going to work very well.
So Joel, on the short side, what are some of the most expensive companies that you're shorting in the Index Plus fund?
Sure, so Salesforce is one, selling at 300 times pre-tax earnings. It's a very good company, hasn't earned a lot of money. Over its history, they are building market share. It's a very good company, but at 300 times pre-tax earnings, that's pretty darn expensive. Another name is Costco. It's a wonderful retailer. It's trading at 30 times earnings, though. With the competition from Amazon and the fact that it's not growing, we think that's pretty extreme valuation as well.
So it's so interesting that as a value investor, price really matters. I mean, you want to buy good businesses. If Costco were a lot cheaper, for instance, or Salesforce were, it might be one of your longs, but right now they're just way overvalued.
Sure. The way to think about this is, I don't live in Manhattan, but if I did and I owned a beautiful 3-bedroom apartment on Central Park, and it was selling for $250,000, well, that would be a steal. At $50 million, it would be ridiculous. But the apartment hasn't changed. It's price that is driven whether it's a good investment or not. So a strategy that says, hey, let me just go out and buy apartments with good views is not really an investment strategy because I didn't tell you what I'm going to pay for them. So price really drives everything in investing.
Where does Index Plus fit into a portfolio? You've got other long-short funds. This is a hybrid. This is new. This is something different. No one else has done it before. Where does it fit into my portfolio?
Right. So number one, Index Plus is 100% net long. Mm-hmm. So most people, when they're putting together a portfolio, most advisors, even most individuals, are comfortable with a certain amount of market exposure. If you had 100% of your money in the market and the S&P could fall, as we learned in 2008, 40% or even more in any particular year, and if you're going to panic out when that happens, you're not a candidate to be 100% long because that could happen at any time. And so you would take a lower exposure. But let's say you chose that I'm comfortable with 60% net long. So really for that, what we're trying to answer is for that portion of your portfolio that you plan to be long, what's the smartest way to do that? And so we think Index Plus plays a part in that part of the portfolio that's 100% long.
So your other funds, for instance, the Gotham Absolute Return Fund, have you found, is your experience that people aren't sticky, they're not sticking with your other funds as well? So you're actually experiencing a problem that you're trying to solve?
Well, we have a similar experience, possibly a little better than many other active funds. When we opened the Absolute Return Fund, we came out of the box when we first opened. Right, in 2012. We had great returns. People saw that. It was a fairly unique fund when we opened it to have the ability to invest in a real hedge fund in the mutual fund space. People saw the results and piled in. Last year was not a great year for us, and we lost some of our investors. We had much better experience than most, but still, if I'm trying to help people stay with us, it points out the fact that no matter what kind of education job we do and how important we explain patience is and stick with it, advisors who are most of who we are talking to for these mutual funds have clients. And whether the advisor has a long time horizon or not, most clients don't. And so they have to deal with that as well. And it's just part of the issue. So in Index Plus, really what we were trying to do is come up with something that would sort of mark the middle ground. There's been a big move to index or passive investing. And it's cheap, and you get the average, and I support it. Very much, but there are a portion of investors who still want to beat the market. And there's a portion, and it's a relatively small portion, of active investors who can actually do that. Of course, we believe we're one of those. I've been doing this for 35 years, and we think we're good at what we do. So for those who want to be active, but still can't take the tracking error problems of being fully active, we're sort of trying to bridge that gap by staying in large cap stocks, by making the base the S&P 500, so you still participate with that, you still get the tax benefits of doing that, but to add an active overlay so you don't have to give up on trying to outperform the market.
Right. So, but the active strategy that you're talking about, of course, when you and I have talked before, from 1985 to 1995, you did run a very tightly focused hedge fund, which you then closed in 1995 and returned the money to investors. That had 34% annualized returns, but it was you said it was just too difficult. And just explain to me, why, when I look at you as a great value investor, and that kind of pure hedge fund that you had early on, was exactly what I would expect from you, but it was just too difficult to maintain for a whole number of reasons. So is that kind of focused value approach that you and your partner Rob Goldstein were so successful at? Is that just a dying breed now? Is that something that we're going to see less and less attempt to do because of all of the things that we've been talking about, of lack of patience and the huge deviation from the market that you have with a strategy like that?
Sure. There were a lot of reasons why we returned outside capital. We didn't close the fund. We continued to run our internal our capital thereafter. One of the issues, and Warren Buffett always says, fat wallet's the enemy of high investment returns. And with a very concentrated portfolio, and in that portfolio, 80% of our portfolio was generally in 6 to 8 names. We were finding our very favorite things. But that's also very volatile when 1 or 2 of those names aren't doing well for a short period of time, either because we were wrong or because our hypothesis just needed a little more time to play out. And there were periods of sharp drops, even though the long-term record was excellent. But as we were successful that period of time, we collected more money, and we thought we could continue to get very high returns with less money, so we did that. Another way to...
And Joel, have you continued that with Rob Goldstein? Are you still doing that?
We did that for over a decade after we returned
Right.
money, and we developed these more diversified strategies that we found both enjoyable to run our own money, and most of our money is invested in these more diversified strategies. But in contrast to a very select portfolio, we're doing more using our valuation skills in a more diverse universe, and we have a lot less issues with 2 or 3 days where 1 or 2 names are particularly hurting us.
Right.
It's easier for people to stay with, and I would just guess Index Plus would be another iteration of that. Even a more diversified strategy when you're really picking the cheapest, which are out of favor, and the most expensive, which are truly in favor, some of those divergences last longer than most people's patience lasts. And so this was our way of really narrowing that weighting to come close to the index. It doesn't make one better than the other. It doesn't mean concentrated investing is better than diversified investing, which is better than what we're doing in Index Plus, which is something that's going to hug the index a little bit more than the fully active part of our strategy. There are different ways to skin the cat. And so what I started saying when I put together the piece that I wrote to introduce Index Plus was the strategy that's best for you is not only one that makes sense, but one you can stick with.
A strategy that makes sense and that you can stick with. A lot of people have decided that strategy is going to be index funds, and a lot of people are invested in just the S&P 500 index fund. But again, in the past, a past interview with me, you were critical of the market capitalization weighted index fund. Is there a better strategy? I mean, there are equal weight index funds for the S&P 500, for instance. There are fundamentally weighted index funds now. I mean, are those a better way to go so that we're not, again, paying up for the most expensive companies all the time?
Sure. Long term, there's been plenty of studies, and we've done the studies ourselves. And whether you do an equal, what happens in a market cap weighted, just to review, is that if a company is overpriced, because you're basing it on price, you by definition own too much of that company.
Right.
If a company is bargain priced, because you're investing by price, you by definition own too little. In a market cap weighted index, you sort of step on every crack and you make every mistake possible. Even if you don't know which are overpriced, which are underpriced, you know if it's overpriced, you own too much. If it's underpriced, you own too little. That's what you do know. So one way to avoid that is to make random errors. So random errors would be an equally weighted index. Sometimes you own too expensive ones, sometimes cheap ones, but on average, you're making random errors. You get the 2% back it costs you to make mistakes every single time. And some of the fundamental weighted index, if they charge low enough prices, also avoid that in another way. Both over time will outperform the market cap weighted index. On the other hand, they do zig and zag differently than the market cap weighted index, and there'll be periods where the market cap weighted index, even 3-4 year periods, where that outperforms. So they still have tracking error less. But if I were advising my mother or my sister or someone like that, I would tell them to use either an equally weighted and some of the fundamentally weighted indexes. They're also, if you do it in the form of an ETF, you get tax benefits a little bit more in where you don't have to pay interim taxes other than for dividends, just only when you buy and sell. And if you use an ETF properly, in my mind, you're a long-term holder.
One investment for a long-term diversified portfolio, what would you have all of us own some of? And the last time actually you did recommend an indexed ETF and hopefully a fundamental value one or an equal weighted one because of the tax advantages and also you're participating in the market.
Sure, so there's a Guggenheim equally weighted S&P 500 index that's both cheap and liquid. And so that would be one of my favorites.
All right. Joel Greenblatt, it's so great to have you back on Wealth Track. Thanks so much for joining us today.
Thanks again for having me.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is, if you are going to invest in an index fund, take Greenblatt's advice and consider an equally weighted index ETF, which gives equal dollar weight to all of the stocks in the S&P 500. As Morningstar explains, equal weighting's primary advantage compared with market cap weighting comes from its massive underweighting of potentially expensive mega cap stocks and overweighting of smaller cap stocks. It may also offer a slight improvement in return by systematically selling recent winners and buying recent losers when it rebalances. ETF fees are being cut across the board, so it pays to shop around for the best deals from reputable firms. Well, next week, leading strategist Jason Trennert and noted financial historian Richard Silla join us to assess the election's impact on the markets and economy. Will it be back to normal or something else? In the meantime, in the extra feature of our website, Joel Greenblatt will give us his take on the elections and a progress report on the Children Attending Success Academy, the charter schools he has been supporting for years. Thank you so much for watching. Please make the effort and vote. The decision on the country's future direction is ours to make. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management, Flexible Perspective, Rosalind P. Walter, and the Fairholme Foundation.